Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Benedikt Schuppli, CEO of Obligate, to discuss how tokenization changes financial market infrastructure. Now, banks and stock exchanges are impacted. Benedikt, it's great to have you with us. Welcome to TradeTalks. And first, let's talk about tokenization. What exactly is it?
Thank you very much for being here, Jill. So tokenization is the process of creating an asset natively or representing an asset that already exists in the form of a blockchain-based token. So this way, anything really from real estate to bonds or equities can be tokenized. And estimates say that 16 trillion US dollar worth of assets will be tokenized over the next few years. And I think it's clear that this will have a tremendous impact on the current financial market and its infrastructure.
How will tokenization affect financial markets, including exchanges?
So if you think about it, originally, the idea of financial markets is to connect issuers of assets, whether it's bonds or equities, as directly as possible with investors, those who lend the money or invest in these organizations. And the current financial market infrastructure is far away from allowing this. We have T+2, settlement takes a long time. It's very siloed. It's separated into national silos. Issuing a bond in the US is very different to issuing a bond in Switzerland. And I think technology is really at a point where it's inevitable that it will change this infrastructure because it's fairly outdated. And particularly blockchain technology has the potential to do this by using smart contracts. So these are programmable code units which can program financial transactions, and tokens. So the representation of this asset or the actual asset just on a different infrastructure, which is a blockchain-based infrastructure. So if you think about it, on a blockchain, particularly also one that we're employing at Obligate, issuers of a corporate bond can directly in a peer-to-peer fashion issue a bond to the investor, which will hold this asset, which has the legal exact same value as a traditional bond in their wallet, and they can transfer it on this infrastructure in just a few seconds and can do this more or less across the globe. And I think banks and stock exchanges are really coming to terms with the inevitability of this, and that it will also affect their business and their value chains.
So when you think about it looking forward, do you think that you'll really see the infrastructure evolving when it comes to banks, when it comes to stock exchanges, central depositories?
Absolutely. And I think it has taken a while for this technology to mature. We've seen, Bitcoin coming up more than 10 years ago. We've seen the first smart contracts coming up with Ethereum in 2015. And it's taken a while for these technologies to mature. And in the beginning, traditional players, incumbents in the TradFi world, as we call it in the blockchain space, were critical, and rightly so. But now the legal framework exists. And most jurisdictions outside of the US have a very clear legal framework allowing assets to be issued in this new form, in the form of a blockchain-based token. And we see basically all large financial institutions ramping up large digital asset units because they know it's coming and it's going to change their business. But of course, because before this will actually come to maturity and we will see mass market blockchain-based bonds and equities, it will still take a few years. But I think, the train has left the station, and now it's really for these incumbents to pick and choose, how are they going about this? Are they working together with technology firms that, have the same type of, let's say, outlook when it comes to everything needs to be regulatory compliant, et cetera. Yeah.
All right, Benedikt, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you very much, Jill, for the time. It was a pleasure.